What are callable bonds? What should you consider when purchasing callable bonds? And how can you tell if a bond is callable before purchasing it on Fidelity, Schwab, and Vanguard? Hello, members and super savers. I hope you're healthy and wealthy. My preference was for healthy and well, as in doing well, but some of you suggested healthy and wealthy. Which one do you like better, healthy and wealthy or healthy and well? Drop a comment below and let me know. Anyway, so callable bonds. These are the 3 questions I'll be covering in today's video on callable bonds. Callable bonds are particularly important for the next steps of our wealth building fixed income journey, especially because many of you hold treasuries, and treasuries are not callable. As we move into other types of bonds, such as agencies, munis, and corporates, you'll be seeing more and more that are callable. So it's best to get familiar with them now. In fact, in our current high interest rate environment, quite a few of the new issue agency, muni, and corporate bonds we've seen lately have been indeed callable. So let's get to it, folks. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. A callable bond, also known as a redeemable bond or callable debt, is a type of bond that the issuer can redeem or call back early before its scheduled maturity date. So, let's say that's you with your callable bond, and that's the issuer. The issuer has the option to buy back the callable bond from you at a predetermined price, known as the call price, on predefined call dates or within a predefined call period. And in most cases, the call price, the price at which the issuer repays the bond to you if they call it early, will be the face value of the bond, although there will be exceptions. A callable bond usually pays a bit more interest than a non-callable bond because it benefits the issuer, not you, the investor. It allows the issuer to repay early and refinance the bond at a lower rate when interest rates fall. As an investor who purchases a callable bond, you're essentially accepting a slightly higher return in exchange for the reinvestment risk that you're taking on in the event that the issuer does redeem the bond and repay you early. Because a bond issuer typically calls a bond when interest rates fall. For example, when an issuer thinks that they can refinance the outstanding debt with a new issue at a lower interest rate. For you as the investor, this means that you, more likely than not, are forced to give up a higher yielding bond and have to look for new investment opportunity in a marketplace that will most likely be dominated by lower yielding new offers. Having said that, you shouldn't assume that a bond will always be called at its first call date either. Bond issuers don't necessarily call at the first opportunity, but generally react to the development of interest rates and other market conditions. So, in our minds, as an investor in a callable bond, you need to be prepared for both scenarios. That the bond may be called early and accept the reinvestment risk that comes with that, as well as the possibility that the bond never gets called, and you have to hold to maturity if you want to wait for redemption by the issuer. Of course, there's also the option to sell a publicly traded callable bond on the secondary market, but if you believe markets are usually efficient, the callability feature of that bond will most likely be reflected in the secondary market price. Right, now that you know what a callable bond is and what you need to keep in mind when purchasing a callable bond, let's walk through briefly how to spot a callable bond on some of the leading brokerage platforms. I'm going to start with Fidelity to explain the key terms for a callable bond, and then we'll move on to Schwab and Vanguard. Let's look at this one here from Federal Home Loan Banks. The no in this call protected column tells us that it's callable, so let's click on it to learn more. And this is the screen that appears. We can ignore this call to feast line as it says no here. But if applicable, this will refer to a bond where the issuer may have certain rights, such as to retract a bond, as soon as it has set aside sufficient funds on its balance sheet and or in escrow to fully service the outstanding bond with all attached obligations. In this sense, it's a clause that can be similar to a call feature, as it might, for example, allow the issuer to repurchase an outstanding bond early, provided that the issuer has already pre-financed that repurchase. But let's leave defeasance for another day, as it does not appear to be applicable to most of the new issue bonds we've seen recently. Right, so this shows that the bond is continuously callable after January 12th, 2024, meaning that the issuer can call or redeem this bond on any day after January 12th, 2024. There is no preset call schedule. If there was, you'd see the schedule down here in this box, which also shows that this is a par call at 100, meaning that if or when the issuer calls this bond anytime after January 12th, 2024, that issuer would pay you back the full face value of your bond along with any accrued interest. In some cases, this call price may be higher than 100 or above par. When the call price is higher than 100 or above par, this is referred to as a call premium. A call premium means you would get back a higher amount than the face value of the bond if it's called early. And it's basically a way for an issuer to compensate you for early redemption. However, the call price is usually the face value, as I said at the beginning of the video, and we haven't seen any call premiums on the recent new issues of agencies, munis, and corporates, but it's nonetheless a nice feature for the investor when it's available. So that was a bond that's continuously callable after a certain date, with the call price set at face value. Here's one that is not continuously callable, as stated here. Here's the next call date, and here is the call schedule down below. This means that the Federal Home Loan Mortgage Corporation, the issuer, can call this bond on these specific call dates only. It can't randomly decide to call this bond on Halloween, for example. And on all these dates, the call price, the redemption, would be at face value, as indicated by this par call note here. And based on our experience and conversations with the leading brokers, generally speaking, most issuers will give you a minimum of at least 5 to 7 business days notice before they actually call a bond. So that was Fidelity. Let's move on to Schwab now. Here we are on the bonds and fixed income search screen. The first giveaway that a bond is callable is that it says right here underneath the bond that it is callable, and in this case, even continuously callable. Here's the first possible call date, and here is the call price. I'll click on this bond for more details, and here is further confirmation that it's callable. If we scroll down, there's a section that shows the call, put, sync features below. Here it shows the bond is continuously callable in whole or in part daily beginning October 27th, 2023 with 5 days notice. Here's the next call price, par basically, meaning at face value, as so often. And here's the next, or in this case of a continuously callable bond, the first possible call date. If a bond is callable, but not continuously callable, meaning that there's specific preset call dates, this is what you would see instead here next to call schedule, basically a list of all possible call dates. Now onto Vanguard. On the day that we looked, all the agency bonds on the list were callable as designated here. This is the next call date, and this is the call price. So let's click on this Federal Farm Credit Bank's one here. And here's the screen that pops up. If I scroll down, I can confirm that the bond is indeed callable on October 26th, 2023 at a call price of $100 on 5 days notice, and that it's continuously callable, meaning that the issuer can call it at any time once we hit the first designated call date. If there was a preset call schedule, the call schedule would look more like this one here, and it would say discrete here rather than continuous. All right, members and super savers, now that you have a better understanding of callable bonds and how you can identify them on Fidelity, Schwab, and Vanguard, check out these videos here to see how some folks in our community are utilizing callable agency bonds to get a bit of a higher yield in the world of fixed income. And do note that all the new issue agency bonds that we've seen recently are callable. As always, I hope you enjoyed this video and learned something new. And I would love to invite you to continue to support our channel through membership so that we can keep producing one-of-a-kind, unbiased, sponsorship-free videos for our super saving community. Get your top-of-mind questions answered in our next live member Q&A on September 22nd at 5:30 p.m. Eastern Time. And check out our latest member videos. Click the join button on our channel page or the link in the video description below for more details about Diamond NestEgg membership. And of course, don't forget to share this video with the fixed income fans that you care about and hit that thumbs up, and see you again very soon with more brand new wealth building content for your financial journey.